Hi, good morning, everybody. Thank you so much for joining us. We appreciate you spending your time and sharpening your tools and learning more information to help you and your clients. So we have three different insurance agents today on our call, and they're going to share some information with you. And currently, we're going to start with Rachel Nelson. So let me introduce you to her. Rachel has been a lifelong resident of the Tidewater area and currently resides in Suffolk, Virginia with her husband and her fur baby, Finn. She began her insurance career in 2001 as an associate agent with a captive nationwide agent selling property and casual insurance. Rachel obtained her life and health insurance, and when Nationwide went independent in 2019, she and another nationwide agent formed Coastal Insurance Agency. They are an independent agency with locations in Hampton, Suffolk, and Franklin, where they specialize in personal and commercial insurance. She mainly works in Hampton, so she's very familiar with the insurance challenges that come with living in a coastal area. Rachel loves what she does, and helping people navigate through their challenging time in the insurance industry is what she does best. So thank you, Rachel, for joining us today and the information you're about to share.
Yeah, thank you, Michelle. Thank you, Allie. Good morning, everyone. I'm going to talk about what I'm going to talk about today is what's going on in insurance. We are in what is considered to be a hard market. And what that means is that we are experiencing higher than normal premiums, stricter underwriting guidelines for eligibility, and less availability of coverage. So, when I say stricter underwriting, that means they're looking at roofs, the proximity to water. Virginia is considered a coastal state, so which means that we have the greatest exposure to winds. Um, and that's kind of what's driving this. A lot of carriers are pulling out of the state. Some carriers, like Nationwide, they're slowing down on writing business, and some carriers are non-renewing. They're just trying to maintain what they have. The things that are driving this is, of course, the we're surrounded by water, which means we have more wind claims. The carriers are actually paying out more in claims than they're bringing in. So, it's kind of a profitability thing. Also, too, insurance carriers have their own insurance. It's called reinsurance. And in these East Coast states like Virginia, North Carolina, that insurance is tripling. So, you know, that's being passed down to the carriers like Nationwide, which is in turn being carried down to the the insureds. So that's kind of the situation we're in. It makes it really challenging to write homeowners insurance. Like I said, the underwriting guidelines are super strict. Like, for example, Progressive in Hampton and Pocosin, if your roof is not 4 years old or newer, then you're not even eligible. So these are the kind of things we're looking at. So that's kind of what's going on, which is going to impact the people who are buying homes.
Great.
Yeah,
So remember, if anybody has any questions, you can put that in the chat and we'll
yeah.
discuss it at the very end. We're going to have all three agents talk on different topics so that you're aware of what's happening in the industry. Rachel, did you have anything else you wanted to share at this time before the questions?
Probably. I think there'll probably be a lot of questions. So,
Okay, perfect. Okay, then we're going to go on to Aubrey. I'm going to introduce her next. Aubrey is originally from outside Nashville, Tennessee, and moved to the Virginia Beach area 10 years ago to open her State Farm agency. She worked as a licensed team member for another State Farm for 5 years prior to that in Knoxville, Tennessee, and somehow already has 15 years of experience in insurance and State Farm. Her husband is also a business owner and a local optometrist, as well as an avid Liverpool football fan like Brandon, who will speak third. They have a 6-year-old boy and a 5-year-old girl and have been thrown into all the youth activities now. She really enjoys volunteering with Junior Achievement of Greater Hampton Roads and DECA. And in her free time, she considers herself a runner, albeit not a fast one. So thank you, Aubrey, for joining us today.
Thank you so much. Can y'all hear me okay?
Yes.
Okay, awesome. Thank y'all for being here. I'm going to talk a little bit on condos versus townhomes, some of the misunderstandings and conceptions of how that affects insurance, because I do see a lot of buyers purchasing condos, townhomes, or no fee condos and not having any clue what that means from an insurance standpoint. What do they need to carry? What does it matter? All I need to do is close the loan, right? But then they have a claim and it really matters a lot. So it's important to me that my clients know what they're purchasing. What does it mean from an insurance perspective? And if they have a claim, how's that going to affect them? And then how do the rates look for that as well? Of course. Okay. All right. So if you look at the pictures here, I'm sure most of y'all been in the industry a while, but is it pretty obvious to you what is what in this picture? Like the top left one, what would be your guess of what that is? This is going to be interactive. So the top left one is a townhome. The way I can usually tell a townhome is if the roofs look different. So if I'm looking at a row and all the roofs look a little different, that indicates to me that the homeowner is responsible for the roof, which typically indicates a townhome. The bottom left one is clearly a condo. It looks like an apartment complex, but this is actually a new condo complex going on Princess Anne. So each unit owner is going to own their little section of that. But in a situation like this, the master policy is going to cover the whole exterior of the building in this condo complex. The bottom right one, though, is really tricky. And this is a rendering of new construction that just went off in the Bay Area, Offshore Drive. And this looks like a townhome or it looks like a condo. It's actually a no-fee condo, which means each unit owner has a condo, but it means nothing to us from an insurance standpoint because these people in the bottom right are responsible for the whole exterior minus the interior walls. It's really hard to know that just by looking at a picture. And sometimes in the listing, if this is listed as a condo, by the way, but a lot of realtors and lenders don't really understand what a no fee condo means from an insurance perspective. And to me, this means this is a homeowner's policy because my insured is going to be responsible for their doors, their windows, their siding, their roof, and everything except for the shared wall in the middle, which they're going to split 50-50 if there's a claim. So it works like a townhome, but it's listed as a condo, which is the confusion. All right, next. All right, I'll talk a little bit about townhomes from an insurance perspective and what this typically means for the buyer. The bottom one is really easy to see that those are townhomes because, like I said, the roof is usually the indication to me, but also each exterior looks quite a bit different as well. This is a strip in Virginia Beach, and this is going to look really familiar to most realtors in the area because we've got a ton of this construction all over the town. Townhomes, the one on the right, they look similar enough, and if it's new construction, it's hard to tell, but this would be an example of townhomes on the top too. It matters whether they're buying an interior or end unit from an insurance perspective on how much coverage they're going to need, because even if the square feet is the same, I need to know how many walls they're responsible for if there's a claim. And the interior unit is going to be a 50-50 split on each wall, but the end unit on a townhome is also going to have that third wall that they're entirely responsible for. So they're going to own basically 3 of the 3.5 walls. And then the interior unit, basically they own the front and back and they share the middle. If there's a fire though, how often does this affect one unit? Almost never if it's in a strip like this. So if there's a fire or water claim, typically the water claims fall in the middle of a wall and it's typically the shared walls because we like to be complicated. And if there's a fire, there's typically going to very minimally be smoke damage to multiple units. And then the insurance companies are rarely going to be the same insurance company. And now they're all going to be kind of deciding what of the walls is going to be built, how much coverage are they going to need for both. And we've got to have a coordination of the clients in construction, right? If you're building a middle wall, you still have to agree on who's going to construct the middle walls. HOA fees and interest rates typically here are going to be lower than condos, as you guys know. I'm not a lender and I'm not a realtor, but I've done this long enough to know typically how that lands for them. They're not paying for a master policy. So the HOA fee is not going to include that in their unit, just for basically whatever maintenance is done by the homeowners association and any shared property that they have, like if there's a pool, as an example, mailboxes, sometimes sheds, parks, things like that. All right, we'll go next to condos. All three of these are condos in Virginia Beach that I've taken pictures of. Some of them look well, Virginia Beach, Hampton Roads area. You guys know from the lender and buyer side, typically it's a lower purchase price, but the interest rates on condos tend to be a little higher if I'm not misunderstanding. Higher HOA fees almost all the time, unless it's a no-fee condo, which we'll talk about. The reason for the higher HOA fees obviously is going to depend on how much shared outside property there is, but it also matters on what is the master policy paying, and I'm going to get into that a little bit. For the master condo association policy, are they only covering the roof and the exterior? Who covers the windows? Are they covering any of the interior walls? I have to read anytime I'm doing a condo, we ask for a copy of the condo bylaws, which of course have to legally be given to the client. They never read them, I promise, most of the time. So it's up to me as an insurance agent to read through the condo bylaws and find the insurance section and read who's responsible for what. Also, on condos, this is changing a lot in the industry on the condo master association policies. The deductible on the master policies have gotten very high. So on this bottom row of condos, we'll just use this as an example. And we'll say there's 4 units attached. It might be 5 or 6, I can't tell. But let's say there's 4 units attached per building. And this has got, let's say 20 buildings, but they're 4 units a building. A lot of the master policies now have $50,000 deductibles per claim. I have seen last week one condo association in the area has a $50,000 deductible per unit.
Wow.
And the condo guidelines, they literally emailed me the whole bylaws last week. I read the whole thing. The bylaws state not only do they cover basically the exterior shell, roof, exterior foundation, and that technically the client is responsible for studs in, which means drywall, flooring, cabinets. Also consider all the plumbing fixtures inside. You need to build the showers out, the kitchens out, carpet, lighting. But there's a $50,000 per unit deductible, not per building, per unit deductible that applies to any claim. That typically flows through to a loss assessment, which nobody knows what it means until you get a nice letter from your condo association after a claim that says, hey, we're paying out for this building. However, we have a $50,000 deductible per unit, which we are assessing to our unit owners. And what are they going to do with that? Do they have $50,000? I see most condo policies are written with $5,000 loss assessments coverage. What that means if you had a $5,000 loss assessments coverage is if I were assessed as a condo owner from my condo association after a claim, and they're assessing me $20,000 because that's their deductible, or that's their deductible split by unit, and my policy only covers $5,000, I have a $15,000 bill that I have to come up with. They can legally do that on the condo association. And so if you as an insurance agent haven't read their bylaws and don't know what their insurance deductible is, they can be really screwed and they're going to be really mad at us after the fact. Why didn't you tell me? So that's important for us to look at, and it's important to consider. It also matters, how much coverage am I giving building coverage wise? Like how much is my unit owner responsible for? Some master policies only cover the roof, and sometimes it's a split, like windows can be the association, the windows can be the unit owner. If they want continuity of how everything looks, a lot of times the master policy is covering it. But at claim time, what am I paying for? It's really important to me that to quote a minimum of $100 to $125 a square foot for building coverage on a condo, because you guys know probably how much a kitchen remodel costs right now. That's how much coverage I see a lot of people have for their entire condo building, which means if they had a condo claim and they had to build out studs in, and all they have they have $50,000 of coverage, that hardly puts a kitchen back together right now. And most people don't know that. They just are like, give me what I need to have, and I don't know. And on our side, on the insurance side, at least with State Farm, I'm basically just coming up with a number here. I don't have a tool to use. I just have to put in a coverage amount. I used to say $75 to $100 a square foot for standard build. It's closer to $125 a square foot for condos on interior build now. That's going to be builder grade. And of course, if I've got a luxury condo complex, I've got to consider, $150 to $200 a square foot for interior now because of the cost of increase on building materials. So that's some of the considerations. Obviously, you guys know, are they renting it? Or are they living in it? That matters. There is a really common misconception that a rental insurance policy costs more than an owner occupied policy. And I don't know about for y'all, but for State Farm, it's usually less. A rental dwelling policy for us, usually apples to apples, costs less than a homeowner's policy, but people for some reason are reluctant to tell us that they're renting out the building. And then they got a claim issue if they don't tell us that. So just one misconception I tell people, it's actually costs less if you're renting it out because I'm not covering a bunch of personal property typically, but at claim time it's going to matter. So let me know how it's being, owner occupied or rented, or if it's being rented as an Airbnb part-time. We have a lot of options for that now because that's the norm, and because it's more common, it's really cheap and easy to do that with us now. So just tell me how it's being used so I can pay out properly at claim time. And then from a liability standpoint, if I'm sued as a condo owner or townhome owner for something that I started, I left the kitchen pot on and it caused a fire to the whole building, is the condo association going to sue me for my negligence? Maybe, probably. We live in a pretty litigious society these days. And how much liability coverage do I have on my policy? So do I have enough liability coverage to build out my whole unit? Basically, is what I'm looking at. So if I've got 8 units in a building and my client is one of 8, I want to make sure that they've got $1 million of liability, which is, by the way, very cheap to do. It's not very expensive to up that. But if I'm responsible for causing damage that damages the whole building, and it's called subrogation after the fact typically, but I'm typically issued a lawsuit from the other carrier, that my policy will take care of it and I'm not stressed about it. They just come to us and say, hey, here's the lawsuit I've gotten, and I'm considering how much that building might cost and do they have enough. Pipes, shared pipes are common, especially we have a lot of condos still in the area that still have Quest piping from the 80s. State Farm is one of the few carriers that still writes it, and I don't even ask about it, ironically, but the age of the unit kind of prices it out for me. But I do know if they're buying a condo that's built in the 80s, that I need to consider that they might have a water claim on it in the next 5 years, and how that's going to affect them. What's their deductible? And let's have a conversation about that. Because if their upstairs neighbor's pipe leaks and it wasn't their upstairs neighbor's fault, it's still my homeowner's policy that's paying out for their damage because their unit owner wasn't liable. It's just a building deterioration that happened. So it's just more common in, the Quest build era, the mid 70s, 80s, that's going to probably happen, and to have a conversation ahead of time about it. Okay, I think I've talked enough about condos. And I've seen in the Chicks Beach Bay Area that no fee condos are more common. So this is largely, I think, a land issue. And the condo, it's like if they don't have enough space, I'm not a real estate agent, so I don't know this well enough, but if they don't have enough space to do the property lines correct for condos or townhomes or whatever the hell they're doing, they're often doing a no fee condo, which from an insurance standpoint, like I mentioned, is just basically a townhome where in my understanding, they just don't kind of own the lot. You own the building, not the lot, but you are responsible for the exterior, the roof, the doors, the windows, the same as you would be if it was a duplex. So if this was a duplex and I owned just one side or townhome, I'm responsible the same way. It's a no fee condo because they're not really doing anything for the condo. They're not doing the exterior landscaping. I don't have a master policy. They're just calling it a condo. So I'm writing an HO5 homeowner's policy for this because I know there's no master policy and we're covering the whole thing. I have seen agents write condo policies for these type of things and only have $50,000 to $75,000 of coverage for this, which is not even in the ballpark of what would happen if there was a fire. So that's important to know. Okay. And I talked a little bit about the liability considerations on these things. Anytime you're attached to a lot of units, you just have to consider that your actions impact more people than just yourself. So I'm not a standalone home. If I mess up and cause damage to my building, it is now affecting other people. If I'm attached to a lot more people, we have to consider animal bites are common, but now I'm attached and close to a lot more people. So if I'm walking my dog, there's more people out to be worried about. Dog bites are one of the #1 liability claim that pays out in the homeowner's side. So it's a conversation to have with people. Just a note, y'all might know this, State Farm's one of the few companies that doesn't have breed restrictions. So if you have a client who has a pit bull or a Rottweiler or any breed that's an issue with other carriers, we have no issues with that. It's just, has the dog bitten someone in the past? That's going to be a problem for anyone, obviously. And then the liability consideration on like shared pipes, maintenance. I have to make sure I'm maintaining my side because it's causing issues with other side people if I don't. And if I have a tub that overflows and I'm on the 3rd floor and I'm the one who caused it, now my liability is going to probably end up paying out for the bottom 2 floors too. And do I have enough coverage for that? So just things to consider when you're attached to a lot of people. Okay. I think that's it. So I've covered a lot. I just, from the real estate and lender side, see a lot of times the buyers don't know by the time they get to me what they've bought and what they're responsible for and why it really does matter once they have a claim. Just making sure on the front end that they've got the right coverage in place for what they're purchasing. Thanks.
Perfect. Great, Aubrey. Just a reminder again, if you have any questions, put it in the chat and we will cover that in the end. And Brandon, as our next speaker, he was gracious enough to let the ladies go first. But Brandon Kopp started Tidewater Insurance in 2020 as a practical way to be more involved in the place where he lived and to mentor and develop employees. The Tidewater team focuses on a high level of service, customer advocacy, and investing in the people and the places where they live. Since moving to the area in 2018, he is proud to call Shadow Lawn his home. His wife and 2 girls can often be found biking around the ocean front or spending time at the beach. So thank you, Brandon, for your time today.
Yeah, thanks for having me. So I'm just going to go over pretty briefly the state of North Carolina and how it relates to insurance and how that is different to us here in coastal Virginia. Virginia is obviously the state we write the most business in, but I would probably say North Carolina is a close second. And it is definitely more challenging than Virginia. So I'll go over why that might be. So we'll start just generally speaking about coastal North Carolina. I won't get into too much of what we consider inland North Carolina, Charlotte or Fayetteville, Greenville, areas like that, because it's so similar to Virginia. But when we talk about coastal North Carolina, most of the business we write is in Currituck County. So Moyock has obviously had a huge influx of new builds, the Outer Banks. I'll talk about that in a little bit because that's kind of its own thing. But how it's different than coastal Virginia, we have the same types of natural disasters, hurricanes, coastal storms, inland flooding. But coastal North Carolina takes a lot of those, at least the brunt of those storms before they get to coastal Virginia. We have the Outer Banks to thank for that. I have a good friend who owns a surf camp in Hatteras Island, and he always says he's just glad to be here for another year. So hopefully Hatteras Island and Outer Banks are here for the foreseeable future. But every year they're always digging sand off the roads there. They actually completely did away with a road called S-Turns down there. If some of you have been down to Hatteras Island, and built a giant bridge instead. So it is slowly becoming more of a possibility that land down there is becoming smaller and smaller. But we love it now that we have it. And why it's so challenging to write business down there is primarily because it's a more competitive market. So what that means is there's just less carriers. So we mentioned companies like Progressive, Travelers, Nationwide. Those types of big carriers won't even touch the Outer Banks. Now, some of those carriers will write business there without wind coverage. And I'll talk a little bit more about that and how we can kind of be flexible with how we write business there that's more cost effective for your clients. But less carriers, it's not a competitive market for insurance, meaning there's just so many more less carriers down there. and then the wind and hail premium. So most of what your clients are paying for down there is wind coverage, and that's because of the higher storm impact down there. Way more hurricanes cause way more damage in coastal North Carolina versus coastal Virginia. And then the next slide. So what can we do about it? North Carolina has a great little thing called NCJUA, or North Carolina Joint Underwriting Association. State Farm is super familiar with it. So Aubrey can be a great resource for you there too. But basically it's not a state entity, but it is backed by the state of North Carolina to offer insurance for everyone in the state. Because it's such a hard state, NCJUA came in and decided, hey, we are going to offer policies in every place that we can. So what we use NCJUA a lot for down there is we always quote them anytime we can, because they will write business no matter where a home is. So I had one yesterday on the Currituck Sound. That was a newer home, but it was just really challenging. No carriers would write it. It was right on the Sound, and NCJUA was really our only option. They're also great for separating out wind, and you'll hear insurance people use the lingo X wind. All that means is it's a policy that excludes wind. And the reason we do this a lot of times is because it's more cost effective. So we can have a carrier, like a State Farm or like a Travelers or a Progressive that comes in, and they will write a policy in a lot of places in coastal North Carolina without wind coverage. So they'll be, hey, we'll take this home, but we're not going to cover any wind damage. So that policy is usually very cheap. So the one I did yesterday was around $800 without wind coverage. Then I went to NCJUA and I wrote the wind policy with NCJUA. Now the wind policy is often a lot more. So it's always good for you as the agent to know, as you're working with insurance people or as you're advising your clients, hey, make sure you check out an insurance agent who can quote NCJUA. Hey, have you thought about quoting wind and excluding wind policies separately? A lot of times it is cheaper. It seems more complicated, but the policies marry together if the insurance agent knows what they're doing. And it's super seamless, especially as a part of a home closing. The carriers are paid separately as just one home insurance payment. So that's what I would advise. And then finally, shop around. That's always great advice. I know Aubrey, even at State Farm, has different products she can offer. Us as independent agency, similar. We work with a lot of different types of products, depending on where homes are. Manufactured homes, I didn't really write anything about this, but we get asked to quote a lot of manufactured homes, and they can be very expensive. NCJUA has options for that. We have other carriers who quote manufactured homes in coastal North Carolina. So make sure you're shopping around. It's always a good thing, especially in North Carolina, because it is not as a competitive market as Virginia. There's not as many carriers. Make sure you know what you're doing with that. And then finally, Outer Banks. So Outer Banks is kind of its own world. It's a bit like the Wild West of insurance here, at least for us in the Mid-Atlantic. It's the hardest place. It's the most expensive place. And it's good to know and good to set those expectations for clients who are looking to buy maybe a primary or secondary with a rental. Probably the policy type we do the most in the Outer Banks is a secondary residence. So someone who lives somewhere else in the US, usually on the East Coast, they want this home to come to when they want to in the summer, maybe in the fall, but then they want to use it as a revenue generator in the off season or in the on season as a rental. So it is really good to know what type of policy your clients need. So like Aubrey said, when people are renting out homes, usually the insurance agent is the last person to know. Sometimes they feel like they need to hide that information for us, like it might be more expensive. I would say it's pretty similar in the Outer Banks. A secondary home with a rental is very possible. usually not as expensive as a primary home because there's not as much personal property coverage. So make sure your clients are asking their insurance person what type of policy type they need. And then second, there are many standard options for the Outer Banks. So a standard option would be a company like USA, State Farm, Travelers, Progressive, but those options are a lot of times not available in really hard places like Hatteras Island, the 4x4 area, in Corolla with all the horses. Most standard options won't write those. So what we do as a broker, independent agency, is oftentimes we look at excess and surplus carriers. So these are usually carriers, not always outside of the United States, but Lloyd's of London is one that people have heard a lot about. They obviously have offices in the US, but they're based in the UK. And we use them in a lot of the hard to find places for coverage. So make sure you're asking about excess and surplus carriers. They just have way less restrictions when it comes to how far away from a fire station a home is, for example, or how close a home is to the beach. A lot of carriers won't write homes right on the beach in Hatteras Island for obvious reasons, but these excess and surplus carriers, while they might be more expensive, usually offers flexible options with that. And again, the same thing goes with NCJOA. NCJOA is a great option for writing wind coverage in the Outer Banks, and it usually pairs nicely with a standard carrier like Travelers or Progressive, who will write the business without the wind. So that is really it. I have my contact info here. Happy to answer any questions. Hopefully there's some questions about Outer Banks. Happy to answer any specific questions too or problems people run into.